I'm Owen Bigland. This is the Inside Edge video blog. I want to address a phenomenon that I'm seeing a fair bit more over the last couple of years, especially in downtown Vancouver here. But this is playing out in New Westminster, Burnaby, Richmond, Surrey, you name it. But especially in downtown Vancouver, which is my main market here. And that is people that are selling investment properties, and in some cases principal residences, after only owning them for a couple of years. Now, nothing wrong with selling a property, but in my opinion, and I talk a lot about this in one of the chapters in my new book, about what I call playing small ball, especially when you're an investor. And it's one of the biggest mistakes that investors make is selling assets, whether that's stocks or real estate, way too soon and not giving it enough time. They see early gains and early capital gains and profit, and it's too tempting for them and they sell it. So let me give you the background on this. I'm working with buyers all the time looking for principal residence condos or investment units downtown. So I'm always on the MLS every day for a couple of hours. When I'm searching for a condo for a buyer, I will go in, weed it down to the price range and the buildings that I like in the area and things like that. But of course, when I see a listing hit, the first thing I always do is go into the history of that property. I want to see what this seller bought that property for, the price, but I also want to see when they bought this property. How long have they held the property? Now, something I'm seeing more and more of the last 2 or 3 years, especially when you get a market that's been on a roll like this for the last 4.5 years, I'm seeing when I go into the history, it's a tenanted unit, so it's an investment unit that this seller is now selling. I go into the history and it shows that they only bought the property 14 months ago or 15 months ago or 2 years ago. And now I'm not privy to all the reasons why this person is selling the investment unit. There's hundreds of them, and there's probably plenty of good reasons why they are selling. Maybe they lost their job. Maybe they became disabled and need the money. Maybe they got a divorce. Maybe they got a job transfer and are moving back east and don't want to manage the property from afar. So there's lots of good reasons to sell, but I'm going to bet dollars to donuts that probably at half of the units that I see being sold that have only just bought them a year or 2 or 3 years ago is for profit taking. They bought the unit 3 years ago, let's say in Yaletown, for $450. Today, they're listing it and going to sell it for $650. Bought it 3 years ago and they're sitting on a $200,000 capital gain, which is pretty incredible. Now, I can see why selling that unit would be so tempting. You've made $200,000 in a little over 3 years on it. But what I talk about in my book is what I call playing small ball, is that people need to be careful with this. Yes, that $200,000 profit is awfully tempting to take. Why not sell it? I think the market is eventually correct, and it will eventually correct. We're at all-time peak prices right now and setting records every day pretty much in downtown Vancouver. The prices I'm seeing come out every week on the MLS are really becoming pretty startling on the new price records that are being set. Why don't I sell it, take my money, and in a year or two I'll buy back in, and I think by then maybe the market's going to correct 10 or 15% and I'll buy back in cheaper. Now, that may work out for you. But keep in mind here, that $200,000 profit, let's say you're going to take it, that money is not going to go all to you. There's a lot of transaction costs involved in real estate that a lot of people I don't think fully calculate. And there's also a lot of transaction costs getting back into the market. So let's look at it. You bought the condo for $450 in Yaletown 3.5 years ago. Today you sell it, you get $650. You've made $200,000 profit. Pretty nice capital gain. But of course, not all that money is going to go to you. First off, you're going to have to pay $20,000 to the realtor to sell your property properly. Next, you're going to have capital gains tax on that $200,000 gain because it's been an investment property. So 50% of the capital gain is going to be taxable at your marginal tax rate. So that's $100,000. You're in a 50% tax bracket at that time, which you probably would be, 45, 48%. Another $50,000 is going to go to the taxman, Revenue Canada. You're also going to have some closing costs, conveyancing fees, another $1,500. If it's a tenanted property, you're going to have to supplement or pay your tenant a year or 1 month, 2 months, maybe 3 months, depending on the situation. So you might have another $4,000 or $5,000 there to get your tenant out and settle it properly. So after you deduct that $200,000 is now shrunken down to maybe $120,000. Still a very nice profit. But the danger here is that what if the market continues to go up? Or let's say you time it right and 2 years from now the market goes down 10%. Well, now you want to buy back in. Now you're looking at buying in. You're looking at property transfer tax to get back in. But the real scary part here is a follow-up to the blog I've done for the last year and a half on the mortgage tightening and the new mortgage tightenings we're just getting now, where they're stress testing conventional mortgages, which is going to affect the investors. You have to put down a conventional mortgage when you're buying an investment property. Now you're going to be stress test plus 2% on the contractual rate you're getting. So it's greatly diminishing your qualification. Now, I don't know where this is ever going to end with these stress tests. They just keep stacking them up. We've had 7 of them since 2008. So it's something to be made aware of. Now, why I call it small ball, it's tempting to take that $200,000 capital gain, or $120 or $125 net to you. But I can tell you that, and maybe you do time it right, in 2 years from now, that $650 condo you just sold is now worth only $600. You look pretty smart then, and it might work. But I can guarantee to you that if you were simply to keep that property, keep it for 20 or 25 or 30 years, let that tenant stay there and pay down your mortgage, the gain that you're going to have on that in 20 or 25 years is going to absolutely blow away what you just cashed in on. It's going to look like a pittance compared to what that property is going to be worth 20 or 25 years from now. And you're sheltering the growth, sheltering the capital gain until you sell it then. Because every now and again, too, I'll see the reverse. I'll go in and look at a condo that's an investment unit, it's tenanted, and I'll see that the guy bought the thing 15 or 20 or 25 years ago. You know, he paid $185,000 for it, and he's selling it today for $700. Or he paid $230 or $240 for it, and he's selling it today at $800. That's where the big money comes in. That's what investors wait for, and that's investing. Selling a condo after 18 months or 2 years is small ball. You're playing 2 innings of a 9-inning game. Now listen, there's lots of good reasons to sell a property. And as I say, I'm not privy to all the reasons why people are selling their investment units. There's plenty of good reasons. Divorce, job transfer, you're injured and off work and you need the money. But timing markets, being tempted by an early and sizable capital gain in the first few years, it's tempting to cash that in. And my advice would be to avoid the temptation and keep it. And it goes directly against really how I make my money. I'm a listing realtor. And when I sit down with clients that call me and say, Owen, I want you to list my property, first question I ask when I sit down with them is, why do you want to sell? What's the reason? A lot of reasons are good. They want to upsize. They want to get into a bigger place. They want to downsize, move out of the lower mainland, move to the island, move to Okanagan. They've owned the property for 30 years. I just had a client that sold several units that he's had for 25 and 30 years. He's getting a little older now. He's into his 70s and just wants to start trimming back his portfolio. Those are good reasons to sell. But a guy that phones me up and says, hey, I just bought it 18 months ago. I'm up $100,000 on it. I'm going to cash in and I'll buy back in later. That's not a great reason. If you really want me to sell it, I will, but I'll be upfront with them and say, hey, why not just keep it? The $100,000 gain is going to be peanuts 20 or 30 years down the road from here. And there's a lot of friction costs involved in buying and selling real estate. It's not like stocks. So keep that in mind. I talk a lot about it in my book, Along for the Ride. It's what I call playing small ball. And investors think long-term and play the full 9 innings, or even better, go into extra innings of baseball. That's where the real money is made. I'm Owen Bigland. If you haven't subscribed to my YouTube channel, please do. Also, you can also get all my video updates by following me on Twitter as well. I'm getting a lot of Twitter followers now, so you can follow me on Twitter as well. See you next week.